Just hours ago, a $2 trillion asset class quietly began migrating onto blockchain rails. This morning, ADI Chain and Shipfinex announced they are partnering to tokenize commercial ships, a sector worth an estimated $2 trillion globally. We are not talking about a fringe crypto experiment. This is the world's merchant fleet, the steel backbone of global trade, now being carved into digital tokens that can be bought and sold like stocks. Why does it matter? Because it ends the era of tokenization being little more than a PowerPoint deck. When a capital-intensive, physically massive industry like shipping starts moving on-chain, you know the technology has crossed the chasm from laboratory to real-world infrastructure. And it is not alone. This shipping deal is merely the latest headline in a month that has seen the financial world quietly rewire itself. Nvidia is teaming up with Wall Street asset managers to tokenize funds tied to real-world assets. Mastercard just dropped $1.8 billion on Bvnk to power its global stablecoin infrastructure. Swift confirmed that over 50 major banks, not a handful of startups, will now implement crypto rails for cross-border settlement. The cause is simple: stablecoins processed over $30 trillion in transfers, proving that 24/7 digital dollar movement is not only possible but cheaper and faster than the correspondent banking system. The banks are no longer asking if they should build on-chain. They are terrified of being left behind. The impact is not some distant future scenario. It is already reshaping market structure. Crypto now represents 13% of the entire alternative asset class market, itself a roughly $2 trillion universe. The tokenization of ships means previously illiquid, multi-million-dollar assets can be fractionally owned, potentially lowering the barrier for ordinary investors and injecting new liquidity into a notoriously closed industry. Meanwhile, stablecoins are becoming the default settlement layer for institutional trades. When JP Morgan, Citi, and Wells Fargo rebuild their settlement rails on blockchain, as they are now doing, settlement risk drops. Collateral moves in seconds, not days. For the everyday saver, that eventually means lower costs on pensions, insurance, and any product that depends on efficient capital markets. The direction of travel is unmistakable. We are on pace for roughly $5.5 trillion in tokenized assets by 2030. Shipping is the proof case, but the logic extends to real estate, private equity, art, and even intellectual property. Near term, expect a wave of regulated tokenization platforms, especially as central banks finalize stablecoin frameworks. The Mastercard deal signals that payment giants intend to become the on-off ramps between digital dollars and everyday commerce. And with over 50 banks now wiring into Swift's blockchain-compatible rails, the network effect is approaching a tipping point. The next 12 months will likely shift the conversation from why tokenize to why haven't you tokenized yet. What we witnessed this morning with ships is not an isolated novelty. It is a signal flare. When a $2 trillion industrial asset class embraces blockchain rails, it confirms that the financial operating system is being rewritten in real time. The winners will not be those who merely hold digital assets, but those who understand which physical world value is moving on-chain next, and position themselves before the pipes are fully built. The $30 trillion in stablecoin flows already proves demand. Today's shipping announcement proves supply is catching up. The infrastructure is no longer theoretical. It is live, and it is scaling faster than most people realize.